Good morning, everyone. Welcome to the monthly real estate webinar brought to you by Sensiba San Filippo. Today's seminar will focus on 1031 exchanges. I have a couple quick housekeeping tips before we dive in. First and foremost, we will be recording this session and you will receive a copy of the session as well as the slide decks and any resources mentioned in an email to you later this week. We hope to have that recording out to you by Friday. If you have any questions for the presenters, we ask that you put them in the Q&A box that is available to you. We have people responding to your questions and the presenters may respond during the presentation as well if it's pertinent to the group. Our session today will be hosted by Tim Tikalsky, tax principal at Sensiba San Filippo. With over 40 years of accounting experience, Tim specializes in tax planning, compliance, and consulting. He is a leader in SSF's real estate and construction industry group and provides services and valuations, litigation support, cost segregation, performance management, retirement, and succession planning. Tim is a frequent contributor to professional and technical publications and has appeared several times as a guest on the Gary Allen on Business radio show on KNBR 680. Tim is joined today by Sensiba San Filippo tax manager Greg Fyfe, who will be answering questions and providing additional information. Again, for those of you who have joined us late, we will be recording this session and you will gain access to the recording by the end of this week. If you have any questions, please don't hesitate to reach out, just put them in the Q&A box and we will get those answered for you. Have a wonderful time. And now here's Tim.
Thank you so much, Megan, and thanks everybody for joining us this morning. Just for total disclosure, actually, in deference to Megan's comment that this will be a conversation on 1031 exchanges, it will really be more on analyzing investments. So as many of my fellow SSF people know, I am a member of CCIM. You'll hear me refer to CCIM, stands for Certified Commercial Investment Member. CCIM is an educational institute founded in Chicago. It's a very well-known and respected organization, and those who go through the program hopefully come out with more knowledge in real estate investment. In fact, it's almost equivalent to a master's in real estate. We're joined by Greg Fyfe, who is actually a CCIM candidate. And he was instrumental in a lot of the backstage calculations that were done for this presentation, as well as been key in developing some of our evaluation software based on the CCIM model. So with that, we will go through. So as I said, it's really not, while this is a focus on 1031 exchanges, it is really more of an analysis presentation to see whether or not a 1031 exchange is actually the right course of action for you. What I like to do in some of these trainings when they're less informal, maybe less technical, is to demonstrate two aims of these webinars. One is the rational aim, which you see on the screen here. The other one, however, is the experiential aim, where I would like to take the audience through an experience. In other words, what are you going to do with this information? I'm not doing a 1031 exchange. Is this really going to be relevant? Well, yes, I hope that we can demonstrate that through the analysis, you can apply this in situations not just whether it makes sense to do a 1031 exchange, but it can any analysis that involves comparing the future stream of cash flows of one option against the other. These techniques will be applicable, and we'd like to demonstrate that as well. So before we dive into the rational aim, I want to take you through the experience piece of this. And in order to understand what and why we're recommending this particular model, you have to understand some basic finance principles. Now, I know we have a diverse audience here. We even have some SSF members who are listening to this and are also part of the real estate group. So this may be fairly elementary to you, but it's necessary. And if I was doing this live, I'd certainly test the audience to see, do you know what an internal rate of return is? Do you know what net present value calculations are? I'm going to assume that you probably have a basic understanding, maybe a high school level understanding of finance and finance models, and we'll kind of take you through that real quickly to make sure that you're up to speed before we get to the actual analysis. So cash flow modeling is simply what I just said. It is taking an option and breaking it down into basically 4 components. You have an initial investment. What monies did you take out of your pocket and put into this investment? What are the cash flows that you're going to have from that investment over the holding period? And by the way, you're going to include then the cash flows that you're going to receive at the end of the holding period. And of course, you have to define the length of the holding period. So in CCIM world and in our real estate investment analysis, in order to calculate that, you always need a beginning and you always need an end. Now, I get pushback from clients sometimes where they say, well, you know, I don't intend to sell the property in 5 years or 10 years. Can you do that analysis? And the answer is, well, it can, but it won't be very compelling. In other words, you wouldn't be able to use the internal rate of return tool if you don't have an end. So when we talk about a 10-year hold or a 5-year hold, and by the way, we don't recommend usually doing these more than over a 10-year period. Nobody can predict the future, certainly in 10 years, nor can they do it in 5 years. But we do need a beginning, we need an end, and understand that the end of the period is typically a hypothetical end, and we'll talk more about that. So again, a key part of the cash flow model is it's not sufficient just to look at the cash flows. You know, what am I going to put out? What am I going to put in? But because of the element of time, we have to put into that the concept of time value of money. We're all, I think, familiar with the concept that if I was going to give you $1 today, that's worth more than if I give you $1 a year from now. Why? Because I can invest that dollar, I can use that dollar today. If I wait 1 year, I've lost the opportunity cost of that money. So again, we talked about that basically. I'm kind of a visual guy. So I like to put these cash flows into a visual chart. And in fact, if you went through the CCIM program, this is how they teach this. You know, they're typically teaching these to non-math majors or non-accountants, which most of the world is. You know, we're accountants, we have a very narrow view, and people get afraid of numbers. So I think putting it in a visual chart to, you know, to kind of get your hands around how the flow of funds works and what we're talking about is helpful. So let's just set up oh, I'm jumping ahead of myself. So before we jump into the timeline and to the T-bars, let's just basically put 2 basic preferences that investors have. And I think these are intuitive to everybody. The first one is more is better than less, right? If I'm going to make an investment and I have the option to invest in one versus the other, if at the end of the day, I'm going to get more from investment 1 than I am from investment 2, that should make me move. Again, assuming that risk is the same between both options. And we're going to assume that risk between these 2 options is relatively the same. So that's one. But the other one is not only if the cash flows were the same, what is the timing of those cash flows? Because sooner is better, as I mentioned. Getting $1 today is certainly worth more than getting $1 in the future. I think we talked about this. So in other words, yeah, those are the basic components. Like I said, we have the cash flows, we have the size of the investment, we have the initial investment, and we have the timing of those cash flows. So here's a little visual using the T-bars. End of EOY indicates end of year, and these are the periods in which we are expecting our investment to perform. In the world of real estate investment, particularly in CCIM world, we compare investments of equal amounts as far as it is investment, and we always start with period 0. Period 0 is the initial investment. So in this particular case, we're investing $1,000 on investment A. We're getting back 100 each year, and by the way, it's at the end of the year. Again, to make the calculations easy, we can certainly modify these when we're doing an actual actual calculation, but for illustration purposes, these flows are coming at the end of the year. And then of course in year 5, this is a 5-year projection, we're looking at then cash flows on the disposition of that investment. So this is a little illustration, very simple. Again, if this was a live presentation, I ask everybody to tell me what's the better investment, A or B? And in fact, go ahead and chat it in. I'm not even sure. Can I see the chat here? But this is fairly intuitive. I don't know. We have spent a lot of time on this. Obviously, investment A, you can eyeball that, is going to be the better investment. You're going to get more cash flows, and you're going to get your investment back. So an easy one to calculate, no brainer. On this one, we have what's called a reversion, where we're saying that, okay, we're actually going to get more on the reversion than we initially invested. Again, obvious answer, investment A wins. We're getting $500 more with even cash flows and the same investment. Lower investment amount. So if I'm going to get the same cash flows between investment A and investment B, but I was allowed to put in less on investment A, obviously investment A wins. Okay, so you don't need any mathematical models to probably calculate that, but notice that in these simple examples, the cash flows are even, right? And equal. Again, this is another one, just illustrates, okay, the earlier we get, the better. So to fit that, but here's what I really wanted to illustrate. How would you determine the difference between these two? And this is where you're going to have to do the modeling. You can't eyeball this. I think I did an analysis. Yes, did I do this? I should have that thing where I can compare my screens, but no, I think it ended up being that investment A was better, but that's irrelevant. The point is you've got to run the numbers to be able to see whether or not this is a better investment, A versus B. So again, introduce the time value of money. Here's the T-bar. So how would we calculate this in the visual? What we're doing is we're putting in a principal amount, we're getting periodic payments, and then we're calculating what the future amount will be and what the internal rate of return of that investment will be. So let me just run to an example. Let's say that an investor pays $10,000 for an investment today, and it's anticipated to produce $28,300 at the end of 10. What is the anticipated IRR? Okay, now we're getting into the modeling. IRR stands for internal rate of return. How would you calculate this? Well, we're putting in $10,000. We're getting back $28,300. We know what the period is. What we're calculating for is the internal rate of return. Now, by the way, I happen to use CCIM calculator for this. Excel does a great job of this. There's a million calculators out there that do this. I think that you would benefit if you're really interested in this area, and I'm speaking to some of the SSF people that are on the call here, is understand the formulas that are inherent in these calculations. When you have a deep understanding of the math, you understand more how to do the calculations. Now, again, you don't need to be a math major to do this. You can plug this into your TI or whatever calculator, but to really get a deep understanding of this, I would encourage you to look at the math. But anyway, what we've done here is we've calculated that the return on this is 10.96% given these parameters. All right. I have a few other examples. We won't spend a lot of time. You'll get the slides. You can kind of get the gist of this. But for the point is that for any one of these factors that are known, if you know at least 3 of them, you can calculate the 4th, right? So if I know what the value is going to be in the future, but I don't know what the present value of that, but I know what the periodic payments are going to be, and I know what the interest rate is, you can always back into these numbers, okay? Another example, this is one with variable. Much more complicated calculation, but again, Excel, any one of these CCIM calculator can do this. All right. So I'm going to pause there and see if there's any questions on that. Did I go too fast? Greg, you're putting your perspective on as maybe one of the attendees. Does that make sense?
Yeah, I know when I was first introduced to some of these concepts, so the IRR just, for me, I kind of thought, how hard is my money working? So when I put my money into an investment, IRR is giving me a sense. Obviously, as an investor, you want your money to work the hardest for you, get the biggest returns. And as far as like the practical, or some of the practical applications, either using this model to compare two prospective pro forma investments, or if you just want to get a sense of how has my investment performed. I think that's something that some of our clients, they don't have a great grasp of what is the returns on this property I bought 10 years ago. And so you can actually kind of go back and recreate and have a sense of what the returns are, and now compare it against some other, what you could get in the market. And
absolutely. Yeah. I think it's a great observation, because I think clients don't know what metric to use. And by the way, I'm not suggesting that internal rate of return is the ultimate metric by which to measure options. In fact, we could do a whole seminar on the flaws of internal rate of return. Okay, so but the point is, you need some type of a metric to be able to measure, as Greg said, how hard is your money working, and what were the alternatives to that investment. You know, I like to joke that I don't have a hard time convincing my real estate clients that real estate is a good investment, but I sometimes have a hard time convincing them it's not the only investment. And when we take their existing real estate assets and plug them into a model like this, which is very easy to do. It's a fairly simple calculation. And as accountants, or as your tax preparer, we have most, if not all, of that information available to us by preparing your tax return. We know what you bought the property originally for. We know what your rents are. We know what your operating expenses are. Really, the only missing factor in that calculation is the fair market value of the property. And of course, there's tons of resources out there. Zillow, which is a great resource to find out, you know, what your home is worth, or what that investment is worth. So just because these look scary, these calculations look pretty complicated, doesn't mean you shouldn't do them. You need a benchmark by which you can analyze your investments. All right, so let's just jump in. Hopefully that wasn't too primary. If you have any questions, again, happy to answer them, but it gives you the basics as to what we're going to talk about next. So let's dive into the rational aim of this and take a very simple example of a 1031 exchange. Again, I am not going to go into the details of a 1031 exchange. If you came to this seminar assuming that I was going to delve into the mechanics of 1031, sorry to disappoint you. So my assumption is that you have a basic knowledge of 1031 exchange, and quite honestly, all you need to know is that if I did a 1031 exchange, generally speaking, if I rolled all my equity over into a replacement property, I'm not going to pay the tax immediately. Okay? There are huge exceptions to that, but the general rule and the attractiveness of a 1031 exchange is that I get to replace my property with at least expensive or more expensive property and defer. And let me emphasize the word defer the tax on the gain of the sale of the relinquished property. Why I say defer, because what you're doing is you're kicking the can down the road with respect to that investment. That gain, that tax liability is baked in to the purchase of your replacement property. And you will pay the tax on that when you dispose of that replacement property, unless you do some proper planning. And unfortunately, one of those planning techniques is to die, at least in current law, before you sell that replacement property and enjoy the stepped up basis. So time permitting, we may talk a little bit about how that enters into our models. But let's just take a very simple example. We'll build on this example as we go through the seminar. Again, you will have access to these slides. We've done our very best to vet the numbers on this. This is kind of an evolving process. I even found myself catching a couple of math errors as late as 8 o'clock last night. I was texting Greg saying, oh my God, I forgot this, I got to change this. So just please forgive any math errors in this. We'll certainly vet those out. But again, it just drives the concepts home. So we got to start with a very simple example. A client buys a piece of property. This could have been years ago, probably 20 years ago, for $100,000. And of course, not unrealistic, that property is now worth $1 million. This scenario plays out, in our client base all day long. Now, if she were to sell that property today for $1 million, she would pay $200,000 in federal tax. She lives in a no tax state. I did that intentionally such that we could make this a lot easier. But obviously, if she lived in a taxable state or disposed of property in a taxable state, she would be subject to state tax as well. Again, for purposes of this, we have kept it simple. She's also going to buy a replacement property that is going to generate a 5 cap. Now, again, my assumption is if you're attending this seminar, you know what a cap rate is. If you don't, real quickly, basically, a cap rate is something that's used in industry standards to determine what the percentage of the net operating income from the property for 1 year, right? NOI for 1 year, what that ratio is to its current value. So cap rate is just simply a ratio. Again, it's net operating income divided by the value of the property. So if I had and purchased a piece of property that today was worth $1 million and it had a 5 cap, what that's just simply saying is that the net operating income divided by the value, $1 million, is 5%. Saying in another way, this property generates $50,000 of net operating income, because as evidenced by the 5 cap. So it's a shortcut way of us to determine what the future cash flows will be as a result of purchase of this property. Okay.
And just one little point here, Tim. I know that can kind of, if people are new to commercial real estate, then kind of the conventional wisdom is how do you value property? Well, you look at comparable sales and things like that. But in commercial real estate, the net operating income really drives the valuation. So you could have two identical properties on the same street, but one has a really high net income. The other one is not managed well, has a low net income, and they're going to be two really different values.
Yes, and it's a very good point. So as you're going to see in our models going forward, we do not assume appreciation in property in our models. The appreciation will come from any escalation of rents that are predicted during the holding period. Because again, you will see that at the end of the investment, whether it's hypothetical or real, we will calculate what the disposition price will be of the relinquished property based on the cap rate. Well, again, how do we know what cap rates are going to be? See, but it is probably a fair assumption that you are buying a piece of property that within a reasonable period of time after its purchase, you should be able to sell it for the acquisition cap rate, the original 5%. But again, values, as Greg points out, are dependent on NOI. And if we have an escalation in the rents, then that would build in appreciation into the real estate. But it is not a factor that we normally recommend that clients do. Look, this needs to stand on its own. Even if this property didn't appreciate in value, if you think if you can sell it for what you paid for it, will this still be a good investment? Okay, but good point, Greg. Thank you for pointing that out. All right, and then of course, the rational aim of this whole webinar is to decide whether or not she should do a 1031 exchange. Now, what is sometimes seems to be rational can be irrational. And what I would say is that, remember what we said was that this person could sell this property and in a sense put $800,000 in their pocket. And what they are contemplating is, first of all, I don't want to pay Uncle Sam $200,000 in tax. There's got to be a way we can do this without me paying the tax. What do you think, Tim? You know, I heard about this 1031 exchange. Is that a good idea? That's what we're trying to address here. Okay. So we have, oh, and I wanted to add this fact here. We'll go back to this fact in a moment. Let me just skip over this. Okay. Sorry, a little bit out of order. All right. So how would you answer her question? Well, we've got two options, just as Greg said. We're going to compare option number one, which is doing a 1031 exchange. And we're going to compare that to option two, which is don't do a 1031 exchange, sell the property, pay the $200,000 in tax, and buy a replacement property for the net proceeds. Okay? So, what is the difference between those two? Well, the first option, let's just talk about the revenue flow that's going to come from the $1 million investment. If I go with option number one, which is the 1031 exchange, I'm going to get, based on a 5% cap, $50,000 of net operating income a year. And by the way, net operating income does not include any other costs such as financing, right? Those type of things. What we're talking about here is in a standard pro forma, what is the expected net operating income from operations, which includes property taxes, right? Repairs, maintenance, utilities, those type of things. It does not include depreciation, as depreciation is a non-cash item. In fact, it's the interesting paradox of real estate investment is that you get to depreciate an appreciating asset, right? That's what makes, you know, real estate so exciting, quite honestly. You can't do that with a stock portfolio. right? You can't depreciate stock, but here we get the ability to depreciate, an appreciating asset. But in option number 2, we're not buying $1 million piece of property, are we? Because we only had $800,000 after we paid the tax. So right away, you're probably thinking, yeah, Greg and Tim, you guys are crazy. I'm not doing this. I mean, not only am I paying $200,000 in tax up front when I could have done a 1031 exchange, but I'm also then only going to get cash flow based on 5% of $800,000. I'm going to cash flow for $40,000 a year. All right, well, hold that thought. All right. So now we know what the income flow is going to be. How do we know what our original investment is going to be? Now, this is a tough concept for people, especially when they do a 1031 exchange. What am I investing if I do a 1031 exchange? Got a lot of choices. Remember, I have to have that beginning. And in fact, maybe I could be so bold as to just switch over here to, well, so here's my analysis as far as the cash flows for option number 1. I told you we started with the 50. We end up with taxable income. We've got a marginal tax rate of 37%. Again, I assumed in the facts that she is going to be in the 37% marginal tax bracket with respect to ordinary income. Again, an assumption that would not be universal for everybody. In fact, Greg has designed a very complicated model which will actually calculate based on the client's facts and circumstances what their marginal tax rate is. But again, for ease of illustration, this is the cash flow. So option number 1, 1031 exchange, we are going to cash flow about $35,000 in the first 3 years and $31,500 after. The reason for the change, won't go into the detail on this. We do have the ability to get a deduction for qualified business income, which real estate is a qualifying investment. That's a freebie deduction we get. So it reduces our tax liability in the first 4 years. That option, by the way, is scheduled to expire in 2021, but it does have a tax implication. By the way, notice how we emphasize after-tax cash flows. Again, one of the basic mistakes that I believe very sophisticated brokers and investment advisors fail to take into account is the tax consequences of these. And the tax consequences can dramatically change your decision, right? It changes the internal rate of return and the net present value. So, all right. So we've got step number 1 out of the way. We've got our 10 years of cash flows for option number 1. How do we determine? Okay, well, might as well just go to the cash flows for option number 2. We started with 40,000, right? Not 50. Cap rate of 5% on 800. Our QBI deduction goes down. Our depreciation deduction, however, we get one. Notice we didn't get a depreciation deduction under option number 1. Why? Well, baked into my facts was this analysis. All right. We have a hypothetical sale in a 1031 exchange, which says that I have the ability to put $800,000 in my pocket and pay $200,000 in tax. And based on the facts, that calculation had us with an adjusted basis in the relinquished property of only $100,000. So remember, I'm trying to resist the urge to jump back and forth in these slides, but we depreciated fully. Oh, here, I don't have to adjust. We bought it for $500,000. We depreciated the heck out of it, right? Wrote off all the depreciable basis that we had. We had to leave at least 20% in land. So really all we have left in our 1031 exchange reinvestment is a $100,000 basis in land, right? Okay. So under this scenario, no depreciation deduction because we have no more depreciable basis left. Now, some of you math techies might say, well, gee, Tim, you bought it for 100. Couldn't you maybe use part of the 100 basis in your depreciable basis for the replacement property? Yes, we'll talk. If you made that leap, you're way ahead of everybody else. But let's just assume no depreciation deduction for the replacement property, because you're basically in the same boat you were before. You were out of depreciation. That might be why you're getting out of this investment, because I got no more tax benefits associated with ownership. If I simply roll into a replacement property, I still won't have any benefits, except for this QBI deduction we talked about, but I won't have any depreciation deductions. All right. So, but under scenario number 2, I am going to get depreciation deductions. Okay. Why? Because I start all over again with my investment. I recognize that the $800,000 or the $900,000 gain on which I paid $200,000 in taxes. So I'm getting a stepped up basis of $800,000. I'm allocating again 20% to land, which is non-depreciable. I'm going to depreciate the building. In this case, it's a residential single family home, 27.5 years. I'm going to get $23,273 of depreciation every year for the next 10 years. That's good. That's a deduction. Is that a cash flow item? No. It's a paper loss, just like the QBI. So this calculation here of cash flow is simply the 40 less the taxes that I pay. And that's how we derive the net cash flows. Okay? So what is the third component, or I should say second component of this? We had the annual cash flows. Again, in order to do an IRR calculation, we have to have a beginning and an ending. We haven't talked about the beginning yet. I'm saving that for the end. The end of this investment is we're going to sell the property, hypothetically or otherwise. And we're going to pay a tax, okay, on that sale. Now, what did I say about option number 1? You didn't pay the $200,000 tax when you did the 1031 exchange, but you're sure as hell going to pay it when you sell the property at the end of the 10-year period, unless you were unfortunate enough to die, or your heirs were fortunate enough to have you die and it was a stepped up basis. But again, the analysis is you're going to pay that $200,000 not in the beginning, you're going to pay it at the end. What about under option number 2? Well, the assumption here is, and again, under both of these assumptions, is that we're going to sell this property for what we paid for it 10 years ago. Remember, I told you, no assumption for appreciation. So if I sell the property that I paid $800 for and I sell it 10 years later, I have taken $232,727 of depreciation, correct? How did I get that? It's just simply that number multiplied by 10, right? Hopefully that's the right number. There you go. So what does that do? Well, when we take depreciation deductions, it reduces our basis. Therefore, that increases our gain. So we have an $800,000 sale for which we have a $232,000 gain, which is just simply basically all the depreciation we took. There was no appreciation. But the good news is that on straight line depreciation, even though we got a 37% deduction for that, right, over the 10-year period, again at the marginal tax rate, we only have to pay tax on the gain to the extent of the depreciation taken at 25%. It's called the section, unrecaptured section 1250. Again, fairly technical, don't want to get in the weeds on that, but there is a differential between the 37% that we're getting as a deduction that she's getting for those years and the potential for recapturing that at a arbitrage between 37 and 25. So again, you're starting to see here, well, yeah, even though I'm getting only 40,000 of NOI on an $800,000 purchase, there might be some tax benefits that I'm actually getting ahead of time that might tip the scale toward option 2 being the better investment. Okay. Not to give away the answer. All right, so that is the second component. The third component, which is the most confusing component of this, really is what is your initial investment in both option number 1 and option number 2? And the reason it is complicated is because you have so many choices here in deciding what you think the investment base is. I'm here to tell you that the answer is always ask yourself, what did you give up? What did you give up if you did a 1031 exchange and rolled that into $1 million piece of property? What did you give up? And what you gave up was the ability to put $800,000 in your pocket, right? Actually, to sell the property for $1 million in this example, pay 200 and put 800 in your pocket. That's your investment base for option number 1. Now you won't remember this, and you'll try to do, and you'll get confused. And now, what was it? Is it the sales proceeds? No, it is what you gave up. Okay. Now, in example number 2, or option number 2, it's a lot easier to calculate, isn't it? Because what did you actually put in the investment? $800,000. Notice they're identical. Okay, and that is important for analyzing these options. Not that you can't analyze an option that has a different investment base, but you're going to want to scrutinize that a lot more closely, because I'm putting more money up front or less money up front. That's going to dictate the IRR. So anyway, I want to drive that point home. So we are starting with an analysis of this. So this is where the rubber meets the road, right here. So there's our $800,000 investment under option 1 and option number 2. Here is our annual cash flows after tax. Now, Greg and I have debated back and forth the reasonableness and the rationale of actually presenting these numbers on a before tax basis. It is what CCIM does. It is what most of the major investment houses do. I think it's a good practice to see what drives, the internal rate of return calculation. But at the end of the day, you're always going to look at after-tax returns. Okay, so it is interesting to see. Yes, I will invest this at, again, 800. That was what I gave up under option number 1. I'm going to end up with $1,050,000. It's going to be $1 million of cash at the end. Again, this is before tax. Okay. Assuming I pay no tax on this, I'm going to put in, $1,050,000 in my pocket. And under option 2, I'm putting in the same 800, but I'm only getting back 840. Oh, well, no brainer, right? Clearly, option number 1 on a before tax basis is different, but we never analyze anything on a before tax basis. Okay. But it's good for illustration purposes. Now look, then after tax, we put in the 800. We net flowed, cash flowed these. We still have option number 2 option number 1 beating number 2 on a after tax basis, right? Not a lot though. Not a lot. Notice the difference between the 7.9 and the 4.15, right? I mean, you paid the piper, okay? So now you're at least getting very close to the same type of cash flow, all right? But client's going to look at that and say, yeah, well, I still think option number 1 is the better one. What do you think? Well, can we do better than that? So let's go back to the concept of cost segregation. Very quickly, again, my assumption is that maybe you're familiar with a cost segregation study. If you're not, I'd love to talk to you. What a cost segregation study does is basically allows you to identify the components of your real estate purchase that are non-structural in nature. And believe me, there's a ton of them, right? You've got decorative lighting, you've got landscaping, you have the wiring that supports machinery and equipment, which in a residential case could include a washer, a dryer, just all kinds of things that under the tax law are deemed to be non-structural in nature, and therefore get a much shorter life than the 27.5 years straight line depreciation. And in fact, under current law, would qualify for what's called bonus depreciation. So take it on faith, for purposes of this webinar, that a cost segregation specialist could probably identify conservatively 30% of the cost of a purchase as non-structural, and therefore qualify 30% of the purchase as being bonus depreciation, or qualify for bonus depreciation, which translates into a deduction immediately in the year of purchase. Okay. So having said that, in my option number 2, where I took the 800 and bought that $800,000 piece of property, I am going to get a first year depreciation deduction of $192,000. Now, remember what I said in the CCIM world, we always do things at the end of the year. So this model was built in a way that said, look, we bought this property at the end of the year, at least for depreciation purposes. I know I cash flowed. Well, it also assumes that you got the NOI at the end of the year, so that's why there's some income. But again, you got to build in assumptions. These models make it easy. But the point here is that I just took if you remember that number, a $23,000 depreciation deduction with a no cost segregation for option 2, and converted to a $192,000 deduction. $192,000. So what do you think that's going to do to our rate of return model? Well, what's going to happen is in the year of purchase, there's that $192,000 deduction that you're going to get. Again, we assume that the rent came at the end of the year, okay, for all you math geeks. And we end up actually having in this case, not a negative tax liability, but a positive tax. What am I saying there when I'm saying that? I've generated $152,000 of negative taxable income from my real estate activity. And again, for future seminars, if I was a real estate professional, I spent more than 750 hours in my activity, that loss would benefit me against my other income. I could take that $152,000 against my wages, my interest, my dividends, capital gains. It'd be a great loss. Again, if you're a real estate professional. So the assumption here is that this individual could benefit from that $152,000 expense, and could in fact get a refund or a reduction of her taxes to the tune of $56,000. That's cash flow. In my book, that's cash flow. And that enters into the cash flow model as such. So notice that we got a big bump in year 1, and then we have our stream of cash flows as we did before. So what does that do to the IRR calc? Of course, we have to change our SPAT, our sales proceeds at the end of the tax year, to take into account the fact that we had $192,000 reduction, right, on our basis. Again, you can go back and review these numbers. But now what do we have? Well, based on, and I call it option 2.1 with a cost segregation study, when compared to the other first and second options, we actually are very close, if not identical, to option number 1, the 1031 exchange. Okay, pretty amazing, but the math works, guys. Okay. Now I know there's some exchange accommodator people on this phone call, and they I don't know, they hate me for this, but they've heard me say this a million times. And it's not that I don't believe in 1031 exchanges. They absolutely have their place. Okay. And with proper tools and planning, and even with the use of leverage, which I'll demonstrate in a second, time permitting, it can be very powerful. But the point that you start with in analyzing a 1031 exchange, or just simply sell the property, pay the tax, you've got to run the numbers. And the point here I'm trying to make is that if we got to a cash flow model that said, if we just simply sell the property, pay the tax, and maybe decide to do whatever we want with those proceeds, right? Without the time restrictions of a 1031 exchange. I don't have to identify property in 45 days. I don't have to transfer in 180 days. For all those reasons, why would you do a 1031 exchange if the after-tax cash flows are this damn close? That's the point. And again, a lot of assumptions went into this to make this. And I didn't fudge these numbers, you know. But that's how the math can work. So time permitting, and I do want to leave open for some questions, but again, here's the points I made. Given that you're so close, why would you do a 1031 exchange in this particular scenario? Let me just give you some more food for thought. And I added this late last night, so forgive any math errors in this. But what if we were to introduce the concept of leverage into this whole model? And leverage, quite honestly, is just simply borrowing the money from the bank, right? And using the bank's money in this investment. Now, remember the scenario. In option number 2, we paid $200,000 in tax, so we only had $800,000 to invest in the replacement property. If I simply were able to go out and borrow $200,000, and again, to make the math easy, I just made it an interest-only loan, $200,000 for 10 years, which would be at a 5% interest rate, probably not unreasonable in this market, but just again, to keep it simple, that interest deduction is deductible. It affects your cash flow. But not only that, it allowed you to buy a $1 million piece of property at a 5 cap, which is going to cash flow you at 50. See, you're going to get the rent on the $1 million. You're not going to, you're not restricted to the rent on the 800. Okay. So working in all these costs together and taking into account the fact that the interest payment is actually going to decrease your cash flow, how do you think this is going to compare to the other 3 options? A little drum roll. I just picked up almost 40 basis points. Well, 33 basis points. Not bad, right? Shows you the power of leverage. Again, a lot of assumptions went into this. I mean, can you get interest at 5%? Could you get an interest only? Even if you didn't get it, if you got a fully amortized loan, you'd certainly be able to spread that and, pay that at the end, pay that back at the end. So my point is, you got to run the numbers, okay? And with a little planning and a little leverage, maybe your 1031 exchange isn't necessarily the best choice. All right.
And Tim, I really feel like this model pulls out, conventional knowledge and wisdom is, clearly the 1031, defer the tax, have more to invest. But I think what I really like about this model is it really pulls out a lot of the tax benefits and attractiveness of real estate with the depreciation, the leverage, being able to not pull money out of your own pocket, but go to a bank. Banks like to lend on really good performing assets and getting that tax benefit of interest. So I think this model, we talked about before tax or after tax. In our world, we love real estate because of all the after the tax benefits. Absolutely. So in a lot of different assets, whether you do stocks, bonds, interest, or different things you can put your money into, there you're not getting these types of tax favors. So this model was something that really helped to open my eyes and made me love real estate even more as a CPA.
Yeah, no, good point. And again, this is a very simplistic model. We have, and with Greg's help, he's really embraced developing a model that's much more. I don't want to use the word accurate because again, we are just looking always at assumptions, but the more complicated you can make the model, the more you get closer to reality. So Very good. Any questions on that? I just dropped in a couple of other, there I made my case for use of leverage. Great opportunity when clients are selling property to look at different property types. Maybe they want to move out of single family home and into multifamily home. I mean, the darlings of real estate classes right now are industrial and multifamily. They're strong. If you're in a single family home right now, you might want to consider rolling into some other asset class. If you've got partnerships or you own these investment in partnerships, very complicated strategies that need to be employed in order to get the benefit. And then there's other options to 1031 exchange, maybe not as exciting, but you can certainly always do an installment sale of your property, spread the gain over the years of the installment, or look at qualified opportunity zones as a way to also defer the tax. So any questions, Megan, do we have from the audience at this point? I know we're bumping up against the time wall.
None so far.
Okay.
But if people do have questions after the fact, a lot of information was shared as they're thinking and the information's percolating. I will be including Greg and Tim's email so that you can reach out with any individualized questions that you have on the topic.
Great. All right, so again, we try to give these, I appreciate everybody's attendance. We're trying to give these on a monthly basis as part of our real estate series. We may take a pass because we got this little thing called busy season coming up in March. But look for future announcements for future presentations, and I hope to see you all again soon.
Thank you, Tim.
Thank you, Greg.
Thank you so much, Tim and Greg, for joining us today and for all of the participants that joined. As I mentioned before, we will be sending out the recording as well as the slide deck and access to Tim and Greg's email address. So if you have any questions, you'll be able to reach them there. That information will be sent to you by Friday. Thank you, everyone. Have a wonderful week.
Thank you.
Bye.
Bye-bye.